Hey everyone, welcome back to Corporate Decoder, the place where we decode the secrets your favorite companies try to hide in plain sight, and today we're diving deep into the financial world of Neiman Funds, a major player in investment management. Get ready for a deep dive into their latest filings. It is going to be an eye-opener. And hey, if you are all about getting the real story behind corporate numbers, make sure you are subscribed and join our awesome Discord community, linked in the description below. Alright, let's get straight into it. We're looking at a report from Neiman Funds, specifically focusing on their various investment funds like the Advisors Capital Total Return Equity Fund, the Advisors Capital Small Mid-Cap Fund, and a few others. Think of these as different baskets of stocks and bonds that these funds invest in on behalf of their clients. The core of this document is all about the money how well these funds have performed over the past year, ending the 30th of September 2025, and what they've been investing in. First off, let's talk about costs. Nobody likes paying fees, but they're a reality in the investment world. For a hypothetical $10,000 investment in the Advisors Capital Total Return Equity Fund, the costs for the last year added up to $199, which is 1.87% of that investment. Similar funds had comparable costs around $195 to $200. Or 1.87%, it is important to remember these are just the fees, not the actual investment gains or losses. Now let's get to the juicy part, the performance. The funds are discussing how the markets did. They mentioned that global stock markets performed well, even better than the US markets this past year. Big growth companies continued to do better than value or smaller companies, and a handful of really big companies, like the Magnificent Seven in the S&P 500, are still driving a lot of the market's success. The total return equity strategy itself focuses on quality companies that return money to shareholders through dividends or buybacks, aiming for a dividend yield higher than the S&P 500. They added new companies like Berkshire Hathaway and Meta Platforms, and top performers included Broadcom and Oracle, likely thanks to their exposure to things like artificial intelligence. However, some companies like Accenture and Zoetis were weaker performers, though the fund managers still believe they'll do better in the future. Looking at how the funds have performed since they started is always interesting. For the Advisors Capital Total Return Equity Fund, an investment of $10,000 made on the 19th of March, 2021 would have grown to $13,931 by the 30th of September, 2025. That is a decent return, but it is important to note that its benchmark, the S&P 500 3% capped index, performed even better, with that same $10,000 investment growing to $17,810. The regular S&P 500 index also beat it, turning $10,000 into $18,277. So, while the fund made money, it didn't quite keep pace with the broader market in this specific scenario. Over the past year, this fund returned about 13.23%. Since its inception on the 19th of March 2021, it averaged around 7.59% annually. Again, the S&P 500 indexes both delivered significantly higher returns, both for the past year and since inception. This tells us that while the fund is generating positive returns, it has been a bit of a laggard compared to its benchmarks. Let's see what these funds are actually holding. For the Total Return Equity Fund, the biggest sector by far is information technology, making up over 31% of the net assets. Financials come in second at 16.62%, followed by healthcare at 12.25%. It is clear this fund is heavily weighted towards technology, which makes sense given the market's recent performance. Now, let's shift to the Advisors Capital Small Mid-Cap Fund. For the fiscal year ending the 30th of September 2025, this fund saw gains in 3 out of 4 quarters. They mentioned that market sentiment was initially positive due to policies expected from a new administration, which especially benefited smaller companies. Tariff concerns caused some pressure, but optimism about trade negotiations helped the fund rebound. Interest rate cut expectations also boosted the market later in the year. For the Small Mid-Cap Fund, that hypothetical $10,000 investment from the 19th of March 2021 grew to $11,520 by the 30th of September 2025. That is a modest gain. However, its benchmarks, the S&P 500 index and the CRSP US Small Cap Index, both saw much stronger growth. The S&P 500 turned that $10,000 into $18,277, and the CRSP index brought it to $12,504. This means the fund underperformed both its broad market and small cap benchmarks over this period. The past year saw an 8.68% return for this fund, which is pretty much in line with the CRSP US Small Cap Index at 8.66%. However, it is a far cry from the S&P 500's 17.60%. Since its inception, the fund has averaged only 3.17% annually, significantly trailing both benchmarks. This highlights a consistent struggle for this fund to keep up with broader market performance. In terms of sectors for the small mid-cap fund, financials and industrials are almost neck and neck, both around 22 to 23%. Healthcare and information technology follow. This shows a more balanced sector allocation compared to the equity fund. Moving on to the advisor's Capital Tactical Fixed Income Fund. This fund focuses on bonds. They report that it performed relatively well against its benchmark. Interest rates declined as expected, and while longer-term treasury yields rose, intermediate-term yields rose less. Credit spreads tightened. The fund benefited from its overweight exposure to preferred stocks and high-yield bonds. They are also using targeted ETFs for specific bond maturities. For the Tactical Fixed Income Fund, a $10,000 investment from the 19th of March 2021 would be worth $10,508 by the 30th of September 2025. That is a small positive return, but again, some benchmarks did better. The Bloomberg US Aggregate Bond Index saw $10,000 grow to $10,000, and the Bloomberg US Intermediate Corporate Bond Index did better, reaching $10,948. So it is a mixed bag, but the fund managed to stay mostly flat or slightly outperform the aggregate bond index. In the last year, this fund returned 2.96%. Since inception, it has averaged 1.10%. The US aggregate bond index had a 2.88% return last year and a minuscule 0.17% since inception. The intermediate corporate bond index did better, with 5.08% last year and 2.02% since inception. The fixed income fund is showing modest gains, keeping pace with or slightly outperforming the aggregate bond benchmark. For the tactical fixed income fund, the vast majority, almost 99%, is invested in exchange-traded funds, with the rest in net cash. This indicates a strategy primarily focused on using ETFs to gain exposure to fixed income markets. Now, let's look at the advisor's Capital Active All Cap Fund. They report strong absolute performance with growth outperforming value, and large cap stocks continuing their lead over mid and small cap stocks. The top 10 largest companies in the market also continue to outperform the rest due to earnings growth and AI exposure. For the Active All Cap Fund, which started on the 1st of December 2022, a $10,000 investment would be worth $15,680 by the 30th of September 2025. That is a really strong performance. However, the S&P 500 index did even better, turning that $10,000 into $17,098. The S&P 500 equal weight index lagged significantly, with $10,000 growing to $13,464. So this fund is doing well in absolute terms, but still trailing the S&P 500. In the last year, this fund returned 14.23%, which again is good, but the S&P 500 returned 17.6%. 0%, however, since its inception on the 1st of December 2022, this fund has averaged an impressive 17.22% annually, which is actually higher than the S&P 500's 20.86% over the same period. This suggests that, at least in its relatively short history, this fund has been a strong performer, though its recent year performance didn't quite hit the S&P 500's highs. Interestingly, 98.93% of the assets in the Active All Cap Fund are in exchange-traded funds. This suggests a strategy that uses ETFs to gain broad market exposure. Next up is the advisor's Capital Growth Fund. This fund launched on the 1st of November 2024, so it has a very short operating history. They mention a strong start, with policy uncertainty initially hurting growth stocks, but recovery in the second half thanks to AI growth, a resilient US economy, and expected interest rate cuts. Their best performers were ETFs focused on S&P 500 growth and Vanguard growth, benefiting from technology and consumer discretionary sectors. Since its inception on the 18th of November 2024, a $10,000 investment in this growth fund grew to $11,697 by the 30th of September 2025. The S&P 500 index saw $10,000 grow to $11,479 over the same period. This is great news for investors in this relatively new fund, as it has outperformed its benchmark since its inception. For its short operating period, the fund achieved a 16.97% return, beating the S&P 500's 14.79%. This early outperformance is a positive sign, though past performance is never a guarantee of future results. Similar to the Active All Cap Fund, the Growth Fund is heavily invested in exchange-traded funds at 97.97% of its net assets. Finally, let's look at the advisor's Capital International Fund. This fund also launched on the 1st of November 2024. It registered a positive return since inception. They note that while the fund focuses on higher quality companies, lower quality companies actually outperformed during this period, causing the fund to lag its benchmark. They saw positive contributions from countries like China and Canada, but detractions from Ireland and Indonesia. Global stimulus helped most regions, but defensive sectors like healthcare lagged. Interestingly, a weakening US dollar against other currencies helped the fund's return. Since its inception on the 18th of November 2024, a $10,000 investment in the International Fund grew to $10,670 by the 30th of September 2025. However, its benchmark, the MSCI ACWI ex-USA NRUSD Index, saw $10,000 grow to $12,486. This indicates that the fund significantly underperformed its international benchmark in this short period. Since inception, the fund returned 6.70%, while the benchmark returned a much stronger 24.86%. This is a significant gap and highlights the challenges this fund faced in its early months. The International Fund's sector breakdown shows industrials taking the lead at 22.67%, followed by financials and materials. It also has about 8.75% in ETFs. Shifting gears slightly, the report also touches on governance. Neiman Funds has a code of ethics for its top executives, and they've confirmed no amendments or waivers were made during the reporting period. This suggests a stable, ethical framework. Interestingly, the Board of Trustees has determined they do not have a specific audit committee financial expert, but they believe the combined experience of the audit committee members provides adequate oversight. This is a common disclosure, suggesting they feel confident in their current governance structure. Let's look at auditor fees. For the fiscal year ending the 30th of September 2025, audit fees were $82,800 and tax fees were $18,000. These are up from the previous year. The principal accountant provided no services to the investment advisor itself, meaning these fees are solely for the funds. This is a good sign of independence. Now let's dive into what the advisor's capital total return equity fund actually owns. The largest holding is Alphabet Inc., Class A valued at $15,728,570, which is 6.79% of the net assets. Microsoft Corporation is also a major holding at $13,155,930, making up 7.74% of the fund. Other key investments include Nvidia Corp, Apple Inc., and Broadcom Inc. This confirms the fund's strong leaning towards technology and growth stocks. For the small mid-cap fund, the largest holding is Coastal Financial Corporation at $6,901,246, representing 6.16% of net assets. Casey's General Stores, Inc. is another big one at $6,218,520, or 5.55%. This fund shows a more diversified portfolio with a focus on financials and retail. The Tactical Fixed Income Fund is almost entirely invested in exchange-traded funds, specifically those related to investment-grade corporate bonds, high-yield bonds, and variable-rate preferred ETFs. The eShares 0 to 3 month Treasury Bond ETF is a notable holding. The active all-cap fund, as we saw, is heavily invested in ETFs, with the eShares Core S&P 500 ETF being the largest holding at $95,977,620, or 98.93% of its net assets. This fund is essentially using an ETF to track the S&P 500. The growth fund is also dominated by ETFs, with Fidelity Enhanced Large Cap Growth ETF and Vanguard Growth ETF being significant holdings. For the international fund, Agnico Eagle Mines Limited is a major holding at $1,415,904. Other significant investments include those in China, Canada, and Ireland, highlighting its global diversification. The note section provides crucial details. We learn that AC Funds LLC is the investment advisor, and Advisors Capital Management LLC is the sub-advisor. The investment objective for most funds is long-term capital appreciation, with the Tactical Fixed Income Fund aiming for total return with capital preservation. The report also details how securities are valued most are considered level 1 or level 2 assets, meaning their value is based on readily available market prices, which is generally a good sign for transparency. The independent auditor, Cohen and Company Limited, gives a clean opinion on the financial statements, stating they fairly represent the financial position of each fund. They've been auditing these funds since 2020, which indicates a stable auditor-client relationship. The report confirms that the principal executive and financial officers have reviewed the disclosure controls and procedures and found no material changes that would affect internal controls over financial reporting. This points to a stable internal environment. My take on all of this is that Neiman Funds manages a diverse set of investment vehicles, each with its own strategy and performance profile. The Total Return Equity Fund and the Active All Cap Fund are showing decent results, though they often trail the broader S&P 500. The small mid-cap and international funds, however, seem to be consistently underperforming their benchmarks, which is a concern for investors. The newer growth and international funds show early promise but need more time to establish a track record. The heavy reliance on exchange-traded funds across several of the funds is a clear strategy, likely aimed at providing broad market exposure and diversification at a lower cost. The costs themselves seem reasonable and in line with industry standards. However, the underperformance in some of the key funds, particularly the small mid-cap and international funds, warrants attention. Investors in those funds should carefully consider if the current strategy is meeting their long-term goals, especially when compared to readily available index funds. Alright, that is our breakdown of Neiman Funds' latest filings. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching, see you next time.